What if I told you that gold might not be the safest store of value anymore? And what if the world's newest digital asset, Bitcoin, could actually be better?
I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
In this video, we're diving deep into a battle between Bitcoin and gold. One has lasted empires and centuries. The other was born in a financial crisis and is already shaking the global economy. By the end of this video, you'll know where to put your money and why the answer might surprise you. Let's start with gold, the heavyweight champion of value for over 5,000 years. Gold has been used as money, jewelry, and a hedge against inflation since the days of pharaohs and kings. Its value comes from its scarcity, durability, and universal acceptance. There's a reason central banks hoard it. Economies used to run on it. But gold has drawbacks. It's heavy, hard to transport, and expensive to store securely.
You look at what gold is, let's start there. Nobody carries around a gold bar, but some people just feel more comfortable holding gold than they do cash. But the reality is nobody actually owns gold, right? They don't physically own it. Some people have coins, but that's, an exception. And so gold itself is actually just a digital transaction that's stored on a ledger somewhere. It just happens to be on a fiat ledger where it's a traditional database held wherever you're buying the gold, at a bank, an investment bank, whatever it may be. There are a lot of vertically integrated organizations that control your access and the distribution and your ability to use traditional gold ownership.
Now, enter Bitcoin. Launched in 2009 by the anonymous Satoshi Nakamoto, Bitcoin was designed to be digital gold, a decentralized, finite, secure form of money. It has no physical form, but thanks to blockchain technology, it's borderless, programmable, and scarce. There will only ever be 21 million Bitcoins, a hard cap written in code. That's something even gold can't claim.
The way that I would describe storing your Bitcoin on a blockchain is like a locker system. So at your high school, you had a locker, and your locker had both a public address, so my locker was C19, and I can give that address to everybody. Hey, go put this envelope in my locker, C19. That's my public address. But only I have the key, the private key, to open that locker and move stuff from one to another. So securing my Bitcoin or cryptocurrency would be the same thing, where you have this blockchain, which is like this digital locker system, and there's a public address, and everybody can know that address, and anybody can deposit into that address. But only I have my key to unlock that.
Gold is scarce, but is it scarce enough? New gold is mined every year, and while supply is limited, it's not fixed. We could discover new gold deposits or even mine it from asteroids one day. Bitcoin, on the other hand, is absolutely limited. Once the last Bitcoin is mined in the year 2140, that's it, no more. Its algorithmic supply curve is predictable and transparent. This creates a powerful narrative. Bitcoin isn't just scarce, it's engineered scarcity. And in a world drowning in fiat money printing, that matters more than ever. Michael Saylor calls Bitcoin perfected capital, a tool for storing energy over time. Gold is good, but Bitcoin, it might be flawless. Try crossing a border with $1 million in gold. Now, try doing it with Bitcoin. Bitcoin exists entirely in cyberspace. You can carry it across borders in your brain as long as you remember your private keys. Gold needs vaults. Bitcoin needs a password. Gold is protected by guards. Bitcoin is protected by encryption and a decentralized network of nodes and miners across the world. And unlike gold, Bitcoin can be divided down to 100 millionth of a unit called a Satoshi, making it incredibly flexible. That's the future of value. Light, fast, borderless. But is Bitcoin really safer? In some ways, yes. It's never been hacked at the protocol level, and every transaction is verified by thousands of computers globally. It's not just money, it's math. Critics argue Bitcoin is too volatile to be a store of value. They're not wrong. Bitcoin can swing wildly. But let's look close. Gold has been stable for decades, but it hasn't performed spectacularly. In the past 10 years, gold is up around 20–30%. Bitcoin, even with massive crashes, it's up thousands of percent. Bitcoin is where gold was in the 1970s, just beginning to enter the mainstream. As adoption grows, volatility is expected to decrease. And unlike gold, Bitcoin has a fixed supply, a growing user base, and increasing institutional interest. Gold was once money. Today, it's mostly decoration. Over 45% of the world's gold is worn as jewelry, while much of the rest sits untouched in vaults. You're not buying groceries or paying rent with gold. Its utility is minimal outside of storage and symbolism. Bitcoin, on the other hand, is being used. In El Salvador, it's legal currency. In countries facing hyperinflation like Argentina or Nigeria, Bitcoin is a lifeline. Online, it's becoming the backbone of a new decentralized financial system. Bitcoin moves, gold rests. When it comes to global acceptance, gold is embraced by tradition, but Bitcoin is adopted by conviction. Governments quietly hold gold, but Bitcoin is being actively integrated into modern finance. Companies like MicroStrategy, Tesla, and nations like El Salvador have put it on their balance sheets. Institutions like BlackRock and Fidelity have launched Bitcoin ETFs. Regular people are sending, saving, and investing with it every day. So, which is the better store of value? Gold is timeless, but it's not frictionless. It's heavy, slow, and doesn't scale in a digital world. Bitcoin is volatile, but it's designed for the internet age. It's scarce, portable, programmable, and it's still early. Gold may have ruled the past, but Bitcoin is engineering the future. And as the world turns digital, the smartest money might no longer glitter. It might just be code. Thanks for watching. Which one of those two you think is a better store of value? Let us know in the comments, and see you in the next video.